Welcome to Old Mutual Capital Markets Day 2025. As we look ahead, today is about unlocking value and growth potential. The Old Mutual leadership team will present a clear investment thesis and credible strategy for long-term value creation. Yuri will outline our strategic priorities and levers for value creation. Clarence will present how the bank will leverage group assets to drive scale and profitability. Prabashni will share execution strategies focused on margin recovery, market share growth, and new opportunities for the cluster. Ranan will discuss group equity value and explain how our focus on ROGEV supports long-term value creation. Casper will deep dive into our cash generation profile and Three Horizons capital allocation approach. Our host for today, Langa, will guide the proceedings and facilitate two interactive Q&A sessions, giving you the opportunity to engage directly with our executive committee. We're determined to unlocking value and growth potential for our shareholders, our customers, and our people.
Good morning, everyone, and a warm welcome to Old Mutual's 2025 Capital Markets Day. To those joining us here in Cape Town, a warm welcome once more. Thank you for coming through. I see, Marius, you made it all the way. We appreciate you for being here. There are many of you who are joining us today coming from afar. To those of you joining us online, I do know I checked the RSVP, Yuri. Some people are dialing in as far as Brazil on the call, so we appreciate all the investors for taking time to join us. I am Langa Mangele, as you know, the head of investor relations, and it is my privilege to be your host today. We will begin just shortly. Just to frame, Yuri will kick us off with a theme, a very simple one, where we are saying we are unlocking value and growth potential. As for myself, my role today is a simple one, is to keep us on track, keep us on time, not to get in the way of a good conversation, make sure that we are on track and we are efficient in the process. So please note that today's presentation is already uploaded and available on our website. Kindly download it. I know some of you like to scribble and take the notes. Pardon us for not printing out the copies, but we've made sure that you have the materials available for you to follow the proceeding today. Let me quickly just run through the full order of the day. I've asked the team to just sprinkle some agenda items, detailed itinerary, to help you track and follow the day, but just to catch you up on an overview. First off, we have structured today's agenda around 4 informative sessions. Each is exploring how Old Mutual will execute on its strategy and deliver sustainable value. As I've said, Yuri will kick us off with the strategy and value creation path. He will be joined by our COO, Zureida. Zureida will briefly just touch on the Old Mutual rewards, as well as talk about data and AI capabilities that we have in a group. We thought that it is important for us that we showcase how the execution enablers are supporting our strategy. So Zureida, you will be joining Yuri on stage for that piece. After that, Clarence will come on stage. As you know very well, Clarence from the Massen Foundation Cluster. He's now the executive CEO for the bank, but also with an executive oversight of the banking cluster of the group. Clarence will come in to deliver our first deep dive on the bank. We will then take a short break, 15 minutes, check your emails, refresh on the coffee just outside, leg stretch, and come back. On the second session, I will then call upon Prabashni. Prabashni is our CEO for the Life and Savings Cluster, which, as you know, now comprise of the 4 underlying business units. I'll not steal the thunder from you, Prabashni. You will come through and deal with that. We will then break for lunch. That will be about, if we stay on track, I'm sure we will do, 5 to 1. That's 1 hour lunch. After when we come back, Ranan, we switch to the financials to you and Casper. We thought that we will do a very brief teach-in on GEV. We receive a lot of difficult questions from you on this topic. So Ranen will just take us through on a teaching session on GAV. After that, Ranen will hand over to our CFO, Caspar Trotsky, to lend just 3 important messages for today. 1, cash generation for the group. 2, our dividend policy. And 3, our approach to capital allocation. In each of these sessions, the first one, there will be sufficient time for Q&A. Yuri, Clarence, and Prabashni will join me here on stage. We'll open the floor right to you, and I will remind you at that time on the Q&A process. Also, on the second Q&A process, we'll follow a similar fashion. Yuri, I will ask you to come back on stage, joined by Ranen and Caspar, as well as Martin and Nico are in the room. They will not be on the stage, but they will be able to take questions at that stage when we are there. Welcome, Michael. Thank you for making it through. So with that, we're happy to get started. Just a reminder, you may just keep your phones on silent. We know that you're busy. You need to be checking your phones now and then, but kindly, please do keep it on silent for us. Let me quickly talk about the Q&A process. It's slightly different from the result so that we are not thrown off the process by that. For those participating online, the webcast is available. There is a tab for Q&A. Kindly submit your questions there. We will take your questions, read them out loud in the room, and make sure that your question is addressed. And for all of you who are here in the room, there are roaming mics. My colleagues will come to you. Please raise your hand, and we will limit just to 2 questions per person. It's much easier for us to have control because I see all of you here. 2 questions, and just for the etiquette, please do introduce yourself, the organizations, and get away with that. We will do our best to make sure that we strike a balance between those who are here in the room as well as those who are online so that everyone's voice is heard. So to set the scene for the day, we begin with strategy and value creation, as I've said. With that, Yuri, please come on stage.
Good morning, everybody. Thank you for being here. Welcome to Mutual Park. I presume this is not the first time that you're at Mutual Park. Maybe it is. New visitors to Mutual Park? Thank you, good. You were signed in adequately, I'm sure, by security. Welcome to you. Thank you for being with us. Thank you for those of us that are online. I think I know who's in Brazil, and it's really early in Brazil. So thank you for that. I think it's 6 hours longer, so that's dedication. Guys, great to have you with us this morning. I think the purpose of the Capital Markets Day really is to just go deeper on some of the really key issues. Coming in as new group CEO, it's been 5 months. And so I was looking back at the slide that we presented at interims, and I think that was like 6 weeks ago. So in normal time, that probably doesn't feel like a long time. You probably feel like maybe not much has happened in 6 weeks. I think for us as a team, it feels like an enormous amount has happened in 6 weeks. So what I wanted to do, and let me just first say, I think the purpose today is we believe, and we've got conviction that we've got a high degree of clarity on what we want to achieve with our business. And this is an exercise in communication. We want to try and find a way of really relaying that to you as best we can. And so look forward to the questions, look forward to the interactions. We've got a whole team here. We've got the Exco team as well as many others who are experts on specialist topics. So look forward to the engagement. But I thought, given the fact that I'm 5 months in, I just thought important to just recap from interims what I said to you 6 weeks ago. Does anyone remember this slide from 6 weeks ago? Okay, you can all just nod. We'll feel better. Thank you, Sally, for saying you remember our slide. But I wanted to just talk about this slide because we presented it then as a kind of a first cut of where we were. And by that stage, I think I was about 3 months in. And we just felt we wanted to give an update and clarity on some of the key issues. I think we spoke about clarity and alignment. with the transition, our group strategic priorities we highlighted to you, so you would have seen that, and we talked about these value-led priority KPIs. I think that piece, really, I could say to you, I feel like as a team, and not just this team, but also deeper on in the business, we've had our conferences, we've had our engagements. I think there's a high degree of clarity and alignment on these issues, and we think that's kind of largely done. I think there were two other pieces that I signaled to you as really key pegs in the ground. The one was around creating shareholder value. I think, and we'll talk later about the sort of size and scale of our group and what the opportunity is, but a real recognition that we have to focus on shareholder value creation to track the scale and the opportunity in our business. And so that piece, we talked about demonstrating resolve on cost. I'm going to give you more detail on our commitments on that. We talked about earning the right to deploy capital. We will go into capital a bit later, but I will also talk to you about some of the opportunities there. Remember we spoke to you about a 3 billion rand share buyback that we announced, but we've got an exciting transaction opportunity that we'll talk about this morning, which is an investment in our business. And then the pivot to RoGav and cash generation. And so we're kind of making good on just going deeper on those really key value creation KPIs. And you'll see that there's on the agenda, there's of course those very specific segments with Ronan and Casper. As far as sharpening execution is concerned, this was a topic actually which in our individual conversations after interims, we got into a lot of conversations with investors around this. And so just to kind of reiterate, we've redesigned our operating model to be a much more devolved structure with greater end-to-end accountability in the clusters. We were previously a much more centralized business. And so really trying to create much more clarity around what sits in the businesses where we want to drive competition for customers and value creation versus what sits at the group. What sits at the group, we've defined in this, what we call our tight versus loose decision framework. I have a pretty good idea of what it takes to execute, and in my experience, the thing that holds back execution is decision-making in businesses like this, right? When there's confused decision-making, when there's structures, when there's a lack of accountability, when there's committees that are checking on one another and people hand-holding and managing each other, that's where the things get slowed down. So we're putting a lot of work in and are very far advanced in prep for the 2026 financial year to be super clear on what the group considers to be tight, which I won't go into detail. It's broadly capital allocation. And I say, guys, capital allocation from Rand 1. I'm very happy to concern capital allocation from Rand 1 is kind of what we think about at the group. Think about those mandates. Risk management, yes. Governance, brand. I mean, some of those obvious things. And then, of course, some of the really key things that you have to do at the group to enable the success of your businesses. And so you'll see there later on, Zoraida will come up briefly to talk about some of those enablers. But really, our ambition is to do as little as possible at the group, to only do those things that are going to really add value to our clusters and help us run this group as a shareholder. We've created these two new segments, life and savings and the banking cluster, which again, we're going to deep dive in. The two CEOs have been running these new clusters now for, I think, 2.5 months, Prabhash, how's it? 3 months. Okay, so she's well into it. She's got all the answers. We're done. It's good. But no, it's been an intense process, I think, for us to kind of form these clusters. But excited to talk to you about it today. So, and you can see there in the executive team, this is kind of the framework very clearly. You've got the customer-facing segments where we push as much activity in those clusters as possible, give as much end-to-end accountability, and then a leaner group, as lean a group as possible. Some are more lean than others. But we so we've cut down on catering. No, we haven't cut down on catering, guys. We're only joking. But we really are looking to be as focused as we can. Actually, this is really the key thing, and it's a belief that comes through the operating model. Is focus creates execution. It creates good decision making, and ultimately creates success. So I just wanted to give you that kind of segue. This is the next step in the communication process and the kind of driving of execution in our business. So yes, it's 5 months in and it's early days, but I think we've got enough clarity to give you some real markers. We will come back to you at results in March, and then we'll come back to you at interims, and we will do a CMD roughly the same time next year. Lunga, if you didn't know that, that's what we're doing here. Bad news. Yeah. So what we want to try and do is just give you these markers around what you can expect from us, what we're chasing, and what you can measure us on. Just giving you some reflections from my heart of the last 5 months. I was saying to the guys, some of the investors earlier, that I'd spent I spent 6 board rounds on the Old Mutual board as an INED, and so when you do that sort of 6 times, reading sort of 2,000 pages, the one advantage is it does give you an opportunity to kind of get to understand the scope and the scale and the opportunity in this group. And really, this is a group with an iconic African business, African brand. I mean, it's got quality businesses at scale. It's got deep roots across the continent. I mean, I'm sometimes stunned by like how long we've been in some of these markets. It's got a 180-year heritage. Now, 180 years doesn't, a lot changes in 180 years. We're not claiming that as a sort of a unique differentiator competitively going forward, but it does provide a platform for us that if we can execute and we can use that platform, it gives us something that is very hard to replicate. So that's a reflection. When I speak to people, I have had the opportunity now of talking to people across the group, externally, internally, and I really am amazed at the depth and the breadth of the brand, right? So I talk to people who are like the foundation market, people who are kind of on the economic ladder, and they have an affinity with Old Mutual that goes back to their parents and their grandparents. And then you talk to somebody who runs a family office for high net worth individuals, and they say, actually, we also want to be associated with Old Mutual. There's an opportunity here to unlock value. But we have to recognize there is value that has to be unlocked in this group, right? So the shareholder value has not tracked the scale and the kind of opportunity that we've got. And so there's a recognition, I mean, restoring margins and returns is kind of the key focus, and execution and disciplined capital allocation. That's how we're going to achieve it. But I also want to kind of cast the eye a little bit further and say that I do have conviction that beyond the value unlock phase, there is an opportunity to take advantage of our scale and our customer reach to generate growth. We have a lot of quality businesses in this group, and I'll show you some of those. But what sets us apart is I think we have an unrivaled, in our sector, reach into the mass market, customer reach and intermediary reach. And so there's an opportunity for us to contest a new banking profit pool that to create growth, as well as to supplement some of the other growth opportunities that exist in the rest of our business. And so those are kind of the 3 really key things that we're focused on. And there's a plan for us that we have in our heads, which I'll take you through. But I wanted to set the scene as to kind of what's in my mind. And my convictions on this thing are, I would say, if anything, stronger than when I came in 5 months ago. So I want to spend just some time this morning just talking about, first of all, that this kind of iconic business. I want to take you back to our value creation phases that we spoke about, our capital allocation horizons, and then our strategic priorities. And what I'm going to try and do is I'm not going to go into the clusters that are going to be deep diving. I just want to highlight later on in the strategic priorities just some of the businesses that actually we are not going to get a deep dive today, but that we think are worth mentioning. So just in terms of this brand and this and what it means. I mean, we've got these accolades that sometimes go unnoticed. Long-term insurer of the year in 24 and 25, top 10 strongest brands in South Africa. If you look at where we are across the continent, we actually are in many of these markets in top 3 positions, and by line of business. And yes, there are gaps and there are opportunities that I'll talk about later. But again, this kind of deep heritage, 13.7 million customers across the continent, and a really deep history. If I look at our business assets, 86 billion in GEV, just in this life and savings business, this mass market distribution that I've spoken about. We also have the largest umbrella fund in the market, with 195 billion in the Old Mutual Super Fund. And our wealth business is a 440 billion assets under management and administration. It's an underappreciated asset and actually something of a powerhouse in the industry that we think is not fully appreciated. On the P&C side, we have had a business in OM Insure that has underperformed over a number. It kind of lost market share. It moved backwards. It's got an 8.7% market share at this point. I've been on that board also actually for about 18 months. No, a bit longer now, 2 years. And just witnessing the turnaround in the performance of that business. And yes, the market turned around. That's absolutely true. But seeing the quality of what has happened in that business, and I used to run a motor insurance business. I know what it takes to, like, what are the signs of a motor insurance business that is turning around, or a personal lines business. And just seeing that, I think that there's an opportunity for us to kind of double down on the better base that we've got and grow that business, grow its market share back to our natural market share. This is not our natural market share. By the way, the turnaround didn't come when I it wasn't as a result of joining the board. It was purely coincidental. The management team are quick to remind me. I went in there to try and fix the business, and then I saw it was actually just doing this. On the asset manager side, I think just highlighting again a couple of key assets. Our alts business is a leader in the market. We pioneered this. We pioneered it because we've got, I think, one of the biggest sources of permanent capital in the market, particularly with our smooth bonus funds, where we can invest for the long term. And then we've got assets like Future Growth, which is a leading credit manager at just over 200 billion. And of course, our banking and lending assets, which we'll talk about a bit later, that lending book of 15.5 billion through just under 350 branches. So we've said we're talking about value creation this morning, and I know that that's what you're interested in. You're interested in this recognition that there's value to unlock, and how do we unlock that value and move forward. I think the first is just to pause for a second on the cash generation of the group. One of the things a group like us has got to do, it's a group with mature businesses. We generate a large amount of cash, and paying careful attention to how we reinvest that cash, what we do with it, is a vital lever in shareholder value. So you see that 27 billion generated since financial year 2022. Significant chunk of it gone back in dividends and share buybacks, but there's also been investment in OM Bank and other growth investments, and you'll see some of that. You'll see a new opportunity that we're going to talk about this morning that we're delighted with. But I think the key thing here is to say to you that, and when we get to the capital horizons, you'll see it. We are really conscious about the quality of this decision making as a group. At my level, and Casper, myself, and the others at the group, we are much more interested in this than in trying to run any of our individual businesses. We leave that to the businesses, and we are focused on round one of how to optimize this. So if you look at you look at the framework of unlocking value and generating growth. I'll talk a little bit more in detail about this later, but I showed you this at interims. What we're going to be showing you now is kind of our focused value creation KPIs. So what we think, what are the targets that we're chasing, and what are our focus areas. So you'll see there we've put out this morning our new targets for these metrics. I spoke to you at half year about our ROGEV and generating ROGEV above cost of equity. And so our target in the medium term is 14 to 16%. We talked about moving to cash generation. That's our dividend growth target of 6 to 9% on a rolling 3-year basis. And then our RONEV targets 15 to 17, VNB margin, and the net underwriting margin. I think on underwriting margin, let me start there. We've lifted our OM Insure underwriting target range from 4 to 6 to 5 to 8. We think that's a recognition of where the business is now, and so we want to sustain our performance. Of course, for half year it was above that, but we think that there's probably a little cyclicality in that. There's been a good underwriting cycle for the market, but we think that that's sustainable, and we need to demonstrate that. That's our target. VNB margin, you would have heard that you saw at half year that we took our persistency variances into our EV, and so the VNB margin is down, and so big task for us, and Prabashini is going to spend a lot of time later talking about how to get ourselves back into range in the 2 to 3, and that's also a big lever of getting ROGEV into the 14 to 16% range. I think to say to you that we are in a two-phase process here to a degree. We're in a value unlock phase. In the value unlock phase, my goal is to get us consistently into range on these metrics, right? If we can do that, then I think that we would have hit a number of really important targets, and we would have demonstrated an ability to unlock some of the value in our business. But of course, beyond that, we will move, and the work is in parallel for generating growth. And I think that generating growth phase will ultimately give us an opportunity to revise some of these targets upwards over time. And we will take you with us on that journey. As I said, we will be talking to you regularly as we progress. I want to just, on cost, one of the really key levers in unlocking value is cost efficiencies. We are targeting at 2.5 billion in cost savings by the end of 2027, which at least $1 billion by the end of 2026. This is basically equivalent to 10% reduction on our 24 base. So work is well underway on this. You would have seen that we put through a restructuring provision at our half year based on some of this initial work. What I want to say to you really here, and this has got to be demonstrated, so we want to give you a clarity around what we're targeting and thinking. Ultimately, we recognize it's about delivery. But we're going to be cascading this into the businesses. The reason why we've moved so fast on some of these organizational changes is to catch our our management cycle. And the management cycle is setting targets, giving accountability, and setting incentives. That's the process we're in. And so we've caught this for next year, and I was determined to do that we can catch it for 2026. And so for 2026, we're going to be able to set the targets. We're defining what cost efficiency means for every area of the business. You can see there it differs by business. VNB margin, there's expense ratio for OM Insure, the cost to income and OM Investments, and so on. And so there's a process that we're going through of just benchmarking where we want each of our areas and businesses to be in 26, 27, 28, and targeting that. We are going to be also cascading all of the targets. It's not just the expense targets. It's actually ROGEV, it's cash generation, it's all of those metrics, taking them through into the underlying businesses. And of course, with a leaner group, managing those shareholder operating costs. And so we'll be pushing it through and pushing it into management incentives. A lot of businesses work like this. We have not worked like this. So this is not how incentive structure has been to date. This is a very significant shift for us and a change in how we approach giving line of sight targets and incentives to our management. I think one of the other big levers in kind of value unlock and ultimately in generating growth is OM Bank, and we're going to give you a serious deep dive later. What I'll say to you, and I've said in the private meetings, that contesting this banking pool is a natural thing for Old Mutual to do. If you look at our lending book, if you look at our branches, we've been doing this since 2007. I think if you look at the convergence of banking and insurance in South Africa, it's not a surprise strategically that this is something that we want to pursue. Of course, it is ultimately in the execution. It's about getting this right. It's about the value proposition that we offer customers, both from a value, but also a customer reach and distribution point of view, and with the technology that we've invested in. So I'm not going to steal Clarence's thunder on talking about some of that, but I do want to say to you, one of the really early things that we did was moving the branches and the OMF distribution into the banking cluster. And so even prior to this kind of our full public launch, we've opened up those channels. And so we have already signed up 140,000 customers onto our banking platform. We are signing up at this stage 5,000 customers a day through those channels. And we have there a big potential. Some of those are new to Old Mutual, but some of them are existing Old Mutual customers. But we really are super encouraged in the early stages of this. And so the focus for us is, yes, there's been a significant investment in the bank, and that will continue for the next couple of years. But we're encouraged by the scale of the take-up. So getting across to capital allocation, of course, as I mentioned, really vital to the success of the group and ultimately to unlocking shareholder value. This will be familiar to you as well. This is our sort of three horizon. We hope, and it'd be nice if it was 3 years, but the three horizons on capital allocation, and really just saying, recognizing that we are currently still, even though our RONAV has been at 15.5 for the half, if you look at the market impact of returns, actually it's been still below the range. So we consider ourselves in Horizon 1. And that in the Horizon 1, we will prioritize shareholder distributions, and hence the announcement of the 3 billion share buyback. But we did say to you, this business is not just about value unlock. It is also ultimately about generating growth. And so we have to consider and be on the lookout for really strategic acquisitions that we can do to deploy capital. And so I'm pleased to announce that we've this morning announced the acquisition of 10X. Now, 10X is a player. It is a retail direct to consumer D2C a player in the investment space. It is one of the leading independent providers of passive investments. Passive investments is, as many of you know very well, is growing extremely fast and projected to grow very significantly still over the course of the next 10 years in South Africa. This is a great business. It's got a 97% direct retail retention rate, a significant retirement business. It's got sticky recurring revenue. And importantly, it has captured 35% of the passive net inflows since financial year 2022 in South Africa. So what we're doing is we are pairing Old Mutual's asset gathering capabilities and our full value chain with what is really a kind of best of breed retail player in the space. So we're super excited about it. I don't think we could not have found, we don't take the decision lightly. We could not, I think, have found an acquisition that is more tightly coupled to our strategic focus areas and our strategy. So it gives us, strengthens our direct and digital propositions, which is an area that we're under-indexed in. It gives us growth in passives and ETFs, and it gives us a scalable technology platform that over time will enable us to actually grow that base without growing the cost base at the same rate. So I think a huge opportunity for us. We're delighted to welcome Toby van Heerden and his team into Old Mutual. I spoke to him this morning. It's a big day for them as well, announcing this. We're delighted. The team will be keeping a shareholding in the business, the enterprise value of 2.2 billion, and of course subject to the necessary conditions and regulatory approvals. But what I really wanted to say to you this morning was we are, as we look to the future, we're looking at value unlock and generating growth really carefully, and looking at how we can match up our capital to drive success ultimately, not just in the value unlock phase, but also in the growth phase. So getting to our strategic priorities then, I'm not going to go into life and savings and OM Bank, but I do want to spend a little bit of time on a couple of the other areas. So this is just on OM Insure, just to give you a sense of where that business is at. I said to you, it's at 8.7% market share. We think there's an opportunity to kind of refill our shoes there in the industry. This business has demonstrated an ability to do programmatic M&A, scaling up and acquiring businesses in niches. So One Financial Services is one of those examples, which is a leader in the heavy commercial vehicle space. We've made significant progress in our data and analytics, which is one of the key things that's underpinned the turnaround in loss ratios, particularly in that retail business. And there's an opportunity for us to grow in the group. There's within the group, there's still a big untapped distribution opportunity, so that's part of it, but there's also a number of others. We think that there's opportunity in specialist insurance lines where we're under-indexed. There's also in direct and digital. Ourwise is our direct digital brand. It's under-indexed compared to some of the big direct and digital brands out there, and so that's a focus area for us. We do think that we can get cost efficiencies out. They are certainly not immune to that push across the group, and many of the same levers there that we'll push in the other clusters, and other optimization opportunities as well. That team is a good example also of where, within a cluster, you don't just have to look to the group to innovate when it comes to using Gen AI, analytics, and the like. That actually people close to the business can also do that in partnership with the group. I wanted to talk about our investment business briefly. Our investment business, we've got to understand, actually spans, our investment capabilities actually span across I refer to it as kind of the asset gathering and the asset management value chain, right? So you've got asset gathering, which is the full activity of what Old Mutual brings scale at, which is right through from advice, administration, the structuring of solutions, and there's a huge, there's obviously significant change in the industry around what those solutions look like, the growth of passives, the growth of quantitative strategies, ETFs. So you can see there, just if you look at if each of these pillars in terms of capabilities, indexation and quants, if you just look at it as a kind of asset class, we add the 68 billion to the Old Mutual and stable there, and already have to add to our already significant institutional base in that 192 billion in index. In Symmetry, we've got a strong multi-manager that is growing and that is gathering assets in the solution space, multi-manager, DFM, best-of-breed solutions. In our fundamental equity and asset and multi-asset, you can see there different propositions. There you can see the Old Mutual Private Clients proposition, actually an underappreciated assets in the group as well. That really competes very favorably with its peers in the market. Future growth we've spoken about, and just showing you there the capability we have in liability-driven investments. Again, 67 billion, a serious player in that niche, and an underappreciated capability. And then our alts business, of course, leader in the market, and super excited about what that business is up to going forward. Just turning briefly to our OMA regions. In Southern Africa, you can see there that actually the rankings of where we sit per segment. We actually are in the top 3 in a number of, in most business lines in these markets. These are markets where we've been in for some cases 180 years. The opportunity, we've come under pressure here recently on margins. You can see there on the life side and the P&C side, and those have been for different reasons, but our first order of business is to fix that, and we're looking at cost efficiencies, we're looking at reinsurance, get that back to where it needs to be within margins and returns. But we have ambition here to fill in. When you go to these markets, you need to play across the value chain at different segments. You need to actually have capability that you can leverage your skills and your brand across the market. So we will be looking at those opportunities carefully over time. But this is the thing this is a business that we think we can deepen our leadership and deepen our scale. I think in East and West Africa, recognition that it's harder in these growth markets, not been there as long in many cases, and so we've got work to do here to really earn the right to deploy capital. And this is an important line in the sand. We really are thinking that we need to complete the restructuring of our balance sheet and the disposal of certain assets. We need to generate cash out of these balance sheets, and we need to improve margins, particularly on the P&C side. So improve margins and returns, and that's the kind of mandate that we've given the teams there. And once that's been done, then we can look at when we've earned the right to deploy further capital in these markets. I think there's already a lot of restructuring that has taken place. Just to remind you, South Sudan, Nigeria, Tanzania. So I think we've demonstrated a resolve on making sure we reshape this portfolio where appropriate. So those are the kind of just going through the different pieces of value creation, capital, and our strategic priorities. What I just want to do is for a few minutes just hand over to Zareda. Zareda is our Group Chief Operating Officer to complete the picture on this integrated execution model and to show what it is that we're focused on as a group. So we've got considerable resources and expertise, but it's going to be really focused on some of these key areas. And particularly, I think Zareda this morning is going to talk about rewards and AI. So let's welcome Zareda.
Good morning. Thank you, Yuri. So as Yuri said, we'll just take a couple of minutes to move from strategy to execution. As the Group COO, my focus is on the strategic enablers that unlock value across the business. I'm not going to talk about all of the integration enablers, but a specific focus on rewards, very importantly with the bank now part of our proposition, but also AI. I know there are lots of questions on how organizations like ours are playing in the space of AI today. So taking a look at how we think about AI, as most of us know, new technologies on its own is not going to drive transformation. So for us, it's about combining this new technology stack, everything from using our data and creating intelligence and insights on that with new automation tools, but not only AI, everything from machine learning to more intelligent AI tools, and then the right conversational interfaces with our very rigorous, robust execution platform. Yuri spoke a lot about our new operating model that's leaner. We've implemented agile practices across most of the delivery teams in the business. And very importantly, we have a global capability hub where we're sourcing the right skills for us to be able to give effect to this. So we really believe that bringing technology together with the execution platform that we have built is an important enabler of our success. This is not a completely new journey for us. We have existing, already established, already used capabilities. We have a Gen AI platform in place, many machine learning tools in place already. This, together with several customer data products that we have built and are already in use, and our enterprise knowledge repository, creates the existing foundations for us to use these new technologies on. But most importantly is we're not deploying AI just generally across the business. We're taking a very specific, very focused, intentional approach to it. In the tech space, it's about improving the software development lifecycle and employing AI in our infrastructure layers. In the customer space, it's about personalization, next best action and next best offer tools. But our core focus here for the planning period is AI for automation, with a very, very specific focus on cost reduction in our operations. So we're looking at our sales and our servicing processes, all the way from pricing, underwriting, to the way we serve our customers. We're very focused on employing automation in our claims process, being our most important moment of truth, and then protecting our business by employing AI and automation models in the fraud and detection and prevention space. I think importantly for us on the way that we're thinking about AI for our business is we're trying to avoid from all the lessons learned from pilots that we've run to date and from others who have progressed quite well down this road, is we're trying to avoid moving from pilot to pilot and being able to figure out how we scale what we do across the business to unlock real value. The next thing I'll quickly talk about is our rewards program. This is much more topical now with the bank being launched. And we really see Old Mutual Rewards as a strategic flywheel for integration that has the ability to drive both bank growth and at the same time create stickiness for our insurance customers. So our rewards program is not new, so we're again building on a successful base. We have 3 million members already. We have almost 50 partners, like quite prominent partners. You'll see them later in the banking and the insurance presentations from Clarence and Prabhashni. But we already have this program that's in place, being used by customers quite a lot. And so we see it as being very well positioned to drive growth. 3 key dimensions for us. We've integrated the bank into the rewards program already. So if you open up the bank app today, you'll be able to see your rewards and use it. Rewards are easily cashable, so it gives customers more options. So being able to use your rewards in a more seamless, frictionless way helps us attract new customers. Secondly, we reward customers, so customers who transact on the bank and then customers who all hold other Old Mutual products receive compelling rewards, so we reward customers for multiple products. And then thirdly, we reward customers for engagement. So we've created an engagement ecosystem, and this is the space that we really look to do more in. So those are the 3 elements that we already have in place and are resulting in the growth that we see today. So as I said, it's not new. There are some credible results that we intend to build on. So today, we already see persistency improvements. Customers with rewards already show 7 to 10% improvements in persistency. Customers who have rewards compared to non-rewards already hold 2 products. That's 37% more than non-rewards customers. And we can already see the behavior that we're looking for. A lot of 40% of rewards today are already redeemed in cash. So we can already see that we have a good foundation on which to build this proposition going forward. So importantly, this is a space that we want to focus on as a strategic flywheel of integration for the group. Thanks, Yuri.
Thanks, Loretta. So guys, just to sum up, I hope what we try to do in this opening session is just to kind of provide you clarity, the big picture around where we're going. I think in particular, a reflection on our scale and the opportunity that I think exists to unlock value. I think we're clear on the value creation phases around what it's going to take to unlock that value and ultimately to generate growth. We've talked about the expense piece in that. We've talked about OM Bank that we're going to get into. So the 2.5 billion commitment on expenses until 2027. On the bank, just the early progress that we've had on customer traction, 5,000 customers a month, 140,000 and counting. Ray, how many have we got now? 150 probably. Yeah. It changes every day. So we're seeing progress in that. I think discipline on capital allocation, the 3 billion buyback, but then also matched with a 2.2 billion investment now in a platform in a business that we think couldn't be more tightly coupled to our strategy, and ultimately a set of strategic priorities that we think are clear for our clusters to be able to execute on. And so we know where we want to push, what the levers are we want to pull, and ultimately it's around kind of delivering on that value unlock to put us in a position to be able to firstly put ourselves into the range of those targets that we've given you, and ultimately down the line give us the opportunity to revise some of those targets upwards. So thank you for this morning, and Langa, I'm going to add back to you.
Thank you, Yuri, and thanks, Zureida, for that very clear presentation this morning and getting us off to a good start. And Yuri, I think the highlight really of the acquisition of 10X, I remember you saying to me, you don't like the idea that we are good at gathering assets, but you don't know what to do with them. So that, I think, puts just a concrete expression of the journey that we are traveling as a group. I realized that I omitted an important thing. I didn't mention the Wi-Fi. So the Wi-Fi, just look for All Mutual presentation with capital letter OMP. It will appear on your device, and the password is changing lanes. One word, changing lanes, capital letter C, capital letter L. And Clarence, speaking of changing lanes, let's switch to the bank. That's the next presentation for the day. And without further ado, over to you, Clarence.
Does it work? Yes, it works. Thank you very much. So earlier on, when Langa was introducing, opening, he said, we also have Clarence Netengwe from MFC, and now he's with the bank. And I said to myself, gee, this MFC label will go with me for the rest of my life. I need to do something about it. But it did happen before, by the way, Langa. When I joined MFC after some time, everyone kept on saying, oh, Clarence the lawyer, Clarence the lawyer. Then I said, well, maybe the best thing for me is to get into the sales side and start selling funeral policies. Maybe this lawyer thing will just simply disappear. And I tried my hand at selling funeral policies, and the rest is history. And everybody has forgotten that actually I'm a lawyer by training. But as it may be, today I'm joined by two of my bank colleagues from OM Bank Exco, Lushendran Patha, who is our Chief Risk Officer. He's a very experienced man. He has been with multiple banks. He was also a CFO of one of the banks in South Africa, and he was also head of group planning for Standard Bank at a point in time. He also happened to have been with the Prudential Authority, where he was head of bank supervision. And during our application for a banking license, he also presided over the application of OM Bank. He didn't approve it because he wanted to come over. He was just part and parcel of that panel that approved our banking application. And we also have Ray Defteros, who is our Chief Information Officer. So I said to him, he needs to come and join me. There was only one problem. He doesn't have a suit. He's a techie. I said, there's no way you're going to come to that presentation without wearing a suit. So he went and bought himself a Nedbank green suit. So he's also joining us for this. Over 80% of the OM Bank, by the way, executive team is made up of people with deep banking experience, totaling over 100 years of experience between them. But over the past few months, I've been teaching them quite a lot about what retail is all about. Because they are just bankers, they teach me about liquidity, funding, capital, this and that. And I said, well, at the end of the day, what is going to win this game is retail. And retail is detail, and I'm going to show you how it works. And they've been seeing that happen over the past 3 months, and now they truly believe that banking is about understanding the retail side of it. I'm going to start the presentation by quoting from Warren Buffett. He said, banking is very good business if you don't do anything dumb. And I can promise you, Old Mutual has not done anything dumb by getting into banking. And we will definitely not do anything dumb over the next few years as we entrench ourselves and embed ourselves in banking. So one of the things that I said to the team, I said, please, I'm not going to drive the slides because I get so much passionate and excited about this bank that I will even forget moving the slides. So I said, please, can you help me with moving the slides? So they are the ones that are driving the slides. I'm just going to have a conversation with you. So why banking and why now? There are 3 to 4 things that I think are very much important. The first one was about capabilities that we have built over the years, as well as the experience that we have gained through the business Old Mutual Finance, where we're involved in unsecured lending. And we have been doing that since 2007. So we have paid school fees in terms of lending, and we've learned a lot in our partnership with Bidvest in terms of the money account. Secondly, there's an opportunity here to increase customer lifetime value and understand our customers better. Because there's one business that generates so much data for you to have a better understanding of your customer, and that is banking. And thirdly, we believe that there's this convergence between banking, insurance, as well as telco sectors. And these are blurring everything. And if you are not part and parcel of that, chances are you will be left behind. So for us, that is very much important. We saw that we needed to defend ourselves and also get into this world where things are just converging between them. But there's also one additional point which is very much important as to why we went into banking. You have to look at the customer demographics of Old Mutual. We will talk about the 7 million customers that we have. But the interesting thing out of that 7 million customers is the number of customers that are younger than the age of 25 is very few of them. When I was in MFC, we struggled to, just get 10% of our base to be under the age of 25. And I'm going to show you that by going into banking, we are going to change the demographics of the, of the Old Mutual Group in terms of customer profile. Let's move to the next slide, please. Now, I want to introduce you to OM Bank. And I know many of you are waiting for this big reveal on the 1st of November. Unfortunately for you, we have gone live. And we are not going to have a big bang, invite the whole world to see and, confetti all over the place saying we are launching the bank. Yeah, we will do that in Q1. But for now, we are just going on our business without any fanfare, and boy, oh boy, we're signing them up. And I'll tell you a little bit about that. So OM Bank is a digital-first full banking offering, which is built on a modern technology stack and focusing on the needs of the mass market as well as the middle income market. That is the business that, the customers that serves Karen very well in that personal finance business. And we have built an unfair advantage in that part of the world, that is the mass market as well as the middle income business, because we know these customers very well. And the platform that underpins OM Bank is built on a cloud-native architecture. Ray always tells me that it is designed to be highly scalable, always available, and it's absolutely secure. And we have been tried so many times in the 3 months. People have been trying us from Nice, and Ray says it's somewhere in France or near Paris. They've been trying to crack the code, trying to penetrate us. And at all times, they are failing because it has been built on a strong foundation, which is absolutely secure. Like I said, and Yuri also mentioned that we are live. And I know for a fact that in the next few minutes, we will definitely hit 150,000 active customers. Because we track these customers real time, each and every hour. Because I'm a retail guy, I always look, how many customers have I signed up? Big tick. And in the morning I wake up, how much money have I made out of them? That's the most important thing for me. Because it's acquiring them, generating revenue out of that. And I will talk to you at a later stage, when I'm closing, about a model which I called land and expand. That means you lend the customer and you expand out of them. That is the thing that is underpinning this bank, and that's the thing that is going to make us win over time. I know that, we currently at 150, we're signing, and Yuri said 5,000 clients or customers per day, but these numbers will ultimately settle down. I'm a retail guy, I understand how it works. There are up and downs in retail, and there will come a point in time when we will, hit a sweet spot in terms of growing those customers. And you will have fluctuations during seasons, and during December it will come down, and over time it will grow up. But the most important thing is that there's something that resonates with them, and they are coming to us almost on a daily basis. Let's move to the next slide. And by the way, we have got a plan to accelerate that growth that you see. And that plan combines a number of things. Number one, we want to migrate our money account customers. And I will tell you a little bit in terms of how many we have migrated. We need to also mine that 7 million Old Mutual customer base that is in South Africa. Thirdly, we're also going to acquire new customers that are new to group through our multi-channel distribution capabilities that are across our ecosystem. Out of the 150,000 customers that I've spoken, 150,000, yes, customers that I've spoken about, we have migrated about 52,000 money account customers. So it tells you a story, 52 money account, what about the other 100,000? It's very interesting. They have never banked with us. They have never banked with us, only 52. So it means that this proposition, it's resonating with customers, and I'll tell you why, it is like that. But I spoke that, we are going to mine the 7 million customer base. We are not naive. We know that these 7 million customers that are, within our South Africa base are already banked by somebody. However, the most interesting thing is that South Africans are multi-banked, and this provides us as Old Mutual with an opportunity to bank those who already trust us. They have placed their trust with us from an insurance perspective. And we are seeing that when we engage with them, they are saying, well, we signed up because we trust you. We signed up because you are a trusted brand to us. That was quite an eye-opener. And since our soft launch, about 60% of customers signed up to date are new to banking with us. And these are the customers that are saying, we're doing that just because we trust you. Here's an interesting fact. 30% of these 150,000 customers are under the age of 25. Remember, at MFC, I was struggling to crack the code to get 10% of them. But within the bank, they've already shown that they are attracted to Old Mutual. So there was a time somebody said to me, and even my son, he once said this thing to me, and it still so. He said, maybe, Dad, you need to take the name Old and just leave Mutual. Maybe we will come. But now it is proven. I don't need to take the name Old because it's an amazing brand and an amazing name. And young people are voting with their wallets, and they're coming over to us. So for me, it's very interesting because, and it sort of confirms one of the strategic imperatives that we have, which was to attract younger customers and change the demographics of Old Mutual. And it's working. And it's very much important for us to take note of that. And I'm quite convinced that we are going to sustain that into the future. And it will be of massive benefit, not to the bank only, but to the greater group over time. Because any business that does not attract young customers is doomed to fail along the way. So you need to think long term, 50 years down the road, because that 25-year-old, 30 years down the road, is the one that has got money, and he's the one that is going to sustain your business. And if you are not attracting them today, they won't have any affinity whatsoever with your brand. And by the way, just to make sure that you say, Clarence, are you still committed to the targets that you communicated to us? Yes, we are not changing those. We are still committed to the 1.1 billion to 1.3 billion target, loss that we communicated to you until monthly break even in 2028. As much as what I've said to you is very exciting, we are not new to this game of banking, and I spoke about Old Mutual Finance. We built a profitable lending book of about 15.5 billion. By the way, it is one of the largest built by a non-banking financial institution in South Africa. I know of no other business which is not a bank that has built such a big lending book, which is profitable. We have got a branch footprint of about 346, which is covering all key economic areas in South Africa, be it taxi ranks, be it in malls, you find Old Mutual Finance. We are strategically located in the right places to support the mass market as well as our middle income. In fact, if you look at us versus the traditional banks versus the insurers, we are probably the one insurance business that has got more branches than our traditional competitors in the insurance space. And we have an exciting customer base within Old Mutual Finance of Money Account, which about 400 to 500K of them are active, and as I said, we are going to migrate them thoughtfully. So it's not going to be something that we do rashly and destroy value in the process. We are doing that very thoughtfully, and Lushendran is keeping me straight in terms of that, saying, Clarence, we can't just rush in terms of migrating these customers. We need to make sure that we don't destroy value in the process of migrating them to the bank. And the Money Account, which is the product I'm talking about, has also proven that rewards can bring together banking and insurance products together. Because we have got customers who have got both, the banking product, Money Account, as well as insurance products across the group. And our mobile virtual network operator, OM Connect, also allows us to differentiate ourselves from a pricing and rewards perspective with our always on banking in that space. So how will we win? Probably that's the question that you have in your mind. For many years from now, you will hear me say the following words. You will hear my team say the following stuff. We are acquiring customers at scale because it is very much important. Customers are at the heart of our business case. And we are increasing engagement with these customers through transactional activities and convenience that we provide to them, thereby generating revenue growth out of them. And we will increasingly monetize these customer cohorts as they mature, such as the young ones that are joining us. As they mature, we will continue to monetize them, and thereby exponentially growing our revenue over time. Customer retention through superior customer experience is absolutely key to our success in the future. And as a leadership team within the bank, we have come together and we said there are 5 imperatives that we need to adhere to, and these are the things that will drive our thinking, that will drive our behavior and how we manage the business. We will be, and we are, a low-cost operations. So cost management is absolutely critical in terms of how we do things. So our mix of fixed and variable costs changes substantially as we scale our customer acquisition. It starts, year one, which is next year in effect for us. It moves from 38% variable in the first year to about 58% by break-even point, which is 2028. And the bank, by the way, ladies and gentlemen, is designed not to have more than 550 employees. And I will repeat that again because some people also do that, right? We are designed not to have more than 550 employees. Why? Because it is anchored on technology and data. That is very much important. And we are going to be excellent in execution, and we are customer obsessed. I wake up at 2 a.m. in the morning, I track what is going on in the bank, I convince almost everybody in the bank have got new sleeping habits now. And the sleeping habits are those sleeping habits of Clarence Netengwe, because they wake up at 2:30. Before, they used to wake up at 8 o'clock, some of them. But now we have changed. Why? Because it is important I'm a retailer, by the way, and in my system, it's about detail and being absolutely obsessed with the customer and everything that goes in your space. And that ethos has to be embedded in each and every person who works in that bank for us to win. You can't win against the big boys if you are not obsessed. And you have to be absolutely obsessed in terms of that. And we're also going to leverage all the available distribution channels within the Old Mutual ecosystem. We are not a digital bank. We have got digital capabilities. We are a digital first, meaning if you want to engage, you have to engage digitally. But the distribution capabilities of this great business have made it what it is, and we're going to leverage that, and we're going to win as a result of that. And above all, we know the customer base that we are playing it. This is traditionally our stomping ground, and we are going to make sure that we play and we play to win in that space. But we are also very aware that we have got a good share of affluent customers, the mass affluent, in Karen and Farad's business. We're also going to go in there and offer what is relevant. There are other businesses, other banks that are similar to us who are also talking about having a bigger share in that space. We have got the advantage of having a business or businesses in our stable that plays in there. So therefore, we will make sure that our value proposition also resonates in that particular part of the market. Initially, priority would be migrating the Old Mutual customers that I've mentioned before, and then we accelerate our growth in terms of the 7 million customer base that we have. And by the way, we don't need, to be honest with you, we don't need new customers in order for us to really win. We just need to tap that base, but we are not naive, like I said to you. And we need to make sure that that base of 7 million, because we know them very well, they want things that are simple, that are fair, that are fast, and they are, everything must always be on. Above all, our trusted brand, existing branch footprint, and the network of financial advisors that I've come to know and I still learn from the likes of Prabhashni, Karen, and everybody else. And I'm quite excited because I'm told that they are looking forward also to helping us win in this space. So we are going to use all the learnings, we are going to use all the support that will be provided to us by our different colleagues in order for us to win in that space. But what is it which is attracting customers to us? Simply, it's our holistic insurance and banking offering. Sometimes people have got this tendency of just, underplaying it. So, well, insurance, banking, it's a very, very powerful combination. And it's not about a funeral product only. It's about the full ecosystem and the full value chain, as well as the product solutions that are there that resonates with customers. If you think it's about a bank account and a funeral policy only, you are mistaken. It's bigger than that. But above all, there's something that the customers are watching and they are seeing. They look at what we're offering and how much we're offering it and what sits inside of it. And they're saying to us, you are about 20 to 30% in terms of value offering to us, better than the market average. In other words, we are 20 to 30% value providers to these customers compared to the market average. You can also go and do the math yourself. Go into our website, you will see what we are offering, for how much we are offering it, and do a comparison with what is in the market. You will see that from a market average, we are 20 to 30% better. Branches are key to our formula for success. And more than 60% of Old Mutual customers want both digital and branch access. And we did a survey a few years ago, and that's the answer that we got. And what are we seeing now in terms of the 150,000 customers that we have acquired? We're seeing proof of that because about 63% of the customers that we have signed up to date, 63% of them have done so digitally. And the other 37% were assisted in the branches. So there's power in the combination of both branch and digital. It can happen outside, and it also can happen inside the branch. And we've placed these branches, like I said, in the right places, and they are definitely helping us through the army of sales consultants that we have in that space, as well as providing other insurance services. And what is encouraging is that these branches, they received something like 3.4 million visits annually. And this is a massive opportunity for us to continue to win in that space. Let me talk a little bit about rewards. And Zureida touched, on the rewards, that it's a flywheel that is going to give us a mighty push in terms of growing our business. So rewards, it's a link between our two execution engines, the one that is being run by Prabashini and OM Bank. For bank customers, they will be able to earn rewards points through their daily transactional activities. So as they swipe, as they engage in their daily financial activities, they will be earning rewards points. They will get cash back through discounts at retailers such as Shoprite, Makro, Checkers, and others that are listed on that slide. And they can redeem the points into their OM Bank account. And this is something which is very popular. It's interestingly, it's very popular with the young ones. And I was saying to my team, maybe they are university students, because in my days, if there's a human being who's broke, it's a university student. So probably they are utilizing that as a form of upkeep. But what is also important is that the insurance customers, particularly in Prabashini mass market space, they can use the cashbacks, the redeemed points, to pay for their premiums if they are under temporary financial stress. So it's a way for them to, from time to time, if they are under stress and they don't have enough, to quickly redeem the points and be able to pay for their funeral policies. So this virtuous cycle have seen our insurance customers migrating to the bank in order to redeem the points and also get cash backs as a result of this thing being available in our space. So customers will unfortunately have to have a bank account in order to join the rewards program at Old Mutual. So before, you could join the rewards program without taking a policy or anything, but it's going to be compulsory in the next few weeks. For you, if you want to get into our rewards program, you have to have a bank account with us. And that bank account must be active. It must not just be a bank account without being active. And the OM Rewards, like I said, has gained a lot of traction, and I think Zoraida mentioned the number 3 million members, and it's continuing to grow. And those who are going to join it in the future will also happen to be bank customers. And by the way, 95% of the 150,000 customers that we have also have got the rewards program. We are well on our way, since launch. We started building this business in 2022. We have gone through the infrastructure build, the regulatory, as well as the testing phases. And we have done this within our planned budget to build this bank and to start scaling it. And all indications are very positive for us. We are fast ramping up, the signing up of customers. So, if you can't recall anything that I've said to you today, I want you to remember the following things, because these are the most important things. I want you to remember the words land and expand model. Because for the next, how many years before I retire? I don't know. that period, if I'm still around, you will hear me continuously talk about land and expand, which means we're going to acquire customers at scale, we'll increase engagement with them, we will monetize the cohort as they mature, and we will retain these customers. But above all, because we are not dumb, we will focus on quality credit growth that is guided by our moderate risk appetite. And if we do that, I can safely go to Mr. Buffett and said, yes, banking is a good business because we have not been dumb in doing it. Thank you very much.
Very much, Clarence, for giving that very passionate delivery of the presentation. I think for also reminding us that the competitive spirit of the group is alive and well. We are now just shifting to the last part of our first session. I've already been getting a lot of questions about when is the Q&A. The Q&A will come shortly after Prabashini. We've provided sufficient time. So with that, please help me welcome Prabashini on stage. And over to you, Prabashini.
Thanks very much, Langa. And good day, everyone. I'm Prabashini Mudli, and I have the privilege of taking you on a dive into our newly formed Life and Savings Cluster. Just 3 months into the role, but I have 23 years of experience at Old Mutual, together with a leadership team of the cluster with even more deep and broad experience than I have, so we're in good hands to move at pace. I will give you an overview of the 4 businesses that make up the cluster, our opportunities we have to unlock value and generate further growth, and conclude with our strategic priorities, which are well aligned to the group's medium-term targets. The Life and Savings Cluster brings together 4 strong, large businesses in the South African business of Old Mutual. The Mass and Foundation Cluster, Personal Finance, Wealth, and Old Mutual Corporate. Collectively servicing a book of more than 5 million customers with mainly life and savings solutions. That book of customers and assets in itself for leverage by the group, and in particular, OM Bank. The majority of those customers are from our Mass business, the undisputed leader in insurance amongst listed life insurance peers, with a 53% new business market share amongst those peers for funeral insurance. In the middle market, our personal finance business invests in multiple intermediary channels, including having the largest network of restricted financial advisors. These are models where intermediaries can select varying levels of support and autonomy with different commercial structures. Leveraging those channels, as well as its private wealth management and private client securities channel, is our wealth business, and it has been able to grow its high net worth client assets with a CAGR of 25% over the last decade, doubling the number of clients every 4 years. And of course, with our acquisition announced this morning of 10X, we are adding the fastest growing passives business to our solution set. Rounding out the cluster is Old Mutual Corporate, our employee benefits business with its leading positions in both commercial umbrella and the group assurance space for large schemes. We're also the leading provider of smooth bonus investment strategy solutions in the country. Across this portfolio, we've created significant value to date. Post the shift in the accounting standards introducing IFRS 17, a large portion of our covered insurance book, due to the methodologies chosen, have a sizable store of future profits locked in on the balance sheet. Our CSM, or contractual service margin, sits at 57 billion, the highest among South African insurers. That's 57 billion rand of profits available for future allocation into earnings. Our allocation rate is between 8 to 12% annually. Added to this are the profits on business that is not covered by the CSM under IFRS 17, as well as non-covered business and new business. Together, this enabled the cluster to deliver 6.4 billion rand in profit in 2024, well balanced across the 4 business units. New business has been strong in a market that's been quite constrained from an economic activity and customer affordability perspective. In particular, I'd like to call out the growth in our mass market risk sales. This was driven by our exceptional tied distribution force, both on the headcount side as well as their excellent productivity. We rolled out fully underwritten risk cover to our mass business via the distribution channels that service that part of the business. And I believe we are now the largest provider of fully underwritten risk cover to the mass market. That's enabling us to grow sales significantly above the rate of growth in the market. On the employee benefits side, which you can see in the bottom left corner of the graph, sales are typically quite lumpy, so I wouldn't be overly concerned by a half-year performance. And of course, we've all heard of the drop in guaranteed annuity business across the industry off the back of the lower bond yields. And that has hurt our margins in our personal finance business particularly hard. So where are the opportunities for value unlock? Firstly, in the Mass and Foundation business, we took a hit at interims by making a basis change around our persistency experience, taking into account the recent experience into our long-term basis, something we don't typically do, but we felt it important to recognize the systemic shift in the funeral insurance business. So this had a negative impact on VNB and the VNB margin, and we have opportunity to recover in this space. Personal finance is in a highly competitive middle and upper middle income market where our recurring premium savings and risk market share are below where it should be for a player of our stature. Taking action here will lead to improvements in both the VNB margin and overall VNB delivery. And then on the wealth and corporate business units, we have really strong platforms and opportunities for further growth. Wealth is focused on having the right solution set and enabling the ease of doing business for intermediaries, whether they're tied or independent. We've made it incredibly easy for those intermediaries to do business with us, and that's come through in the pace of growth in our wealth platforms, both local and international. And of course, with the 10X acquisition, we now are supercharging our direct-to-customer play in the savings and investment space. We're providing a very strong complement to our intermediated channel offerings, and we will be able to capture additional growth in that savings market. Corporate's strong competitive proposition set continues to serve us very, very well, but we do have an opportunity to improve the ease of doing business for individual intermediaries, in particular post the change in regulatory reform introducing the two-part changes. I'll go into a little bit more detail unpacking that in a couple of slides. So it's easy to identify what we need to do to recover margins and unlock value, but how exactly are we going to do this? So firstly, we have reorganized our value chains, as Yuri mentioned, for better execution and delivery, for focus and clear accountability. Secondly, we're sharpening the competitiveness of our propositions that we take to market. Third, recovering margins through mix, volume, and cost efficiencies. Fourth, scaling our strong Old Mutual Wealth platform. And finally, reimagining the corporate business in a very low-growth employee benefits environment. So unpacking the formation of the cluster a little bit and this operating model change that we talk about. So the setup of the cluster is largely about federating delivery with end-to-end value chains with very clear accountability and decision-making to improve focus and drive efficient delivery at pace. This is quite different to our recent setup, where we had quite a few capabilities centralized, from product, technology enablement, and customer servicing. The centralized setup served us incredibly well. It enabled us to re-platform our retail businesses. It enabled us to shift a large portion of our technology estate into the cloud. However, over time, when the pendulum swings too far, inefficiencies can creep into a model and make it increasingly tricky to get alignment across the value chain. In our new setup with the cluster, the very light cluster overlay will ensure that our customer experience is coherent and we extract synergies both on the revenue and expense side where they exist without heavy layers of overheads and inefficient structures. And of course, prevent the pendulum from now swinging too far into the other direction. The big focus will be to drive culture and ways of work that empower, hold clear accountability, and drive commercial outcomes with a customer focus. Moving on to our prized Massen Foundation market position, unlocking value here requires more than just an operating model change to respond to the systemic shifts in the funeral industry. So while our persistency challenges have been partly from affordability challenges in the customer environment, the overall impacts of the economy, it's also as a result of significant activity from non-traditional players, like banks with different business models and cost structures. So earlier I mentioned a 53% market share of new business amongst listed insurance peers. While still leading, when taking into account all players in the funeral market, our share drops to around 19%. We have several ways that we can address the challenges and the shifts in this environment, from leveraging an excellent distribution capability to enhancing our proposition both through the solutions coming on stream with OM Bank and an acquisition we made a couple of years ago and entering the funeral services space. I'll talk about that a little more shortly. We're also continuously looking to improve the quality of business that comes into our environment. We will keep investing in our strong tied distribution model, but take strategic actions on the propositions, which I just mentioned, but also improve the quality of new business with integrated affordability controls in the sales process. We're upping our game in terms of premium collections. And when I mentioned this the previous day, someone responded, but aren't you doing this anyway? Well, there's been a change in the debit order collection environment a few years ago with the introduction of DebiCheck, which is a new way of authenticating debit order collections. And we have yet to perfect our processes post this change. So there is definitely room for improvement. We're also adding additional channels for customers to pay missed premiums, including pay at and the use of PayShap in distributing claims. And we've seen good early outcomes. So Two Mountains, which is a funeral services business that also has a microinsurance license. So you know how people say there are two certainties in life, death and taxes. Well, the reality is about half of the consumers who purchase funeral insurance are actually involved in the arrangement of a funeral service. Providers of integrated offerings appeal to this part of the market. The largest such provider in our market, an unlisted insurer, a mutual insurer called Avbob, and there are others like Doves, Itseboletu, and others. So businesses with integrated funeral services exhibit higher persistency, higher average margins, and higher average case sizes. So we acquired Two Mountains, a funeral services company with an insurance license a few years ago. We're in the process of corporatizing it and rolling out a national footprint. And we've started integrating it into the Old Mutual funeral offering. So far, we've done the integration at claim stage and are seeing good take-up from Old Mutual customers. But the real big benefit lies in integrating the funeral services offering at sales stage. And this is the work that we're busy with now. Sales under the Two Mountains brand of funeral products has been growing exceptionally well. At interims, we reported 160% year-on-year growth, albeit off a low base. Moving on to the middle market. Our middle market business requires a slightly different set of actions for margin recovery. From a risk market share high of over 13%, we hit a low of 9.1% in 2021. This was for a variety of reasons, and mainly as a result of loss of support in the independent intermediary financial advice space. We're slowly clawing back support here, and the actions that we are taking are starting to bear fruit. You can see in H1 2025, we already increased our risk market share up by 1%, hitting 10.1. The strengths that we have to leverage in the middle market are a modular retail product platform, large tied distribution, high value rewards program, and a truly modernized digital advisor platform. Our immediate focus to recovering margins will be to continue to simplify the value chain and drive sales effectiveness. Our retail product platform is close to completion. Our new savings and investments range is busy being rolled out, and the initial feedback from both tied advisors and independent advisors has been excellent. We continue to enhance Integrate, which is a digital platform for advisors, which seamlessly brings together rich customer data with financial needs analysis and planning tools for a truly efficient advisor experience. After rolling this out in the personal finance business, we're now starting to pilot it in our mass business as well, evidencing the synergies across the various businesses in the cluster. We're driving cost efficiencies hard across the value chain, and I was glad to hear, Zureda, that we are focusing on unlocking value and efficiencies through automation, ongoing optimization, and modernization of our technology stack. At the same time, we continue to scale our advisor force, growing a restricted financial advisor network to a headcount of 500. And as OM Bank matures, Clarence, we look forward to the additional banking solutions that will complement our customer value proposition in the middle market. So this slide, literally stolen from Clarence's pack, is just to remind you that OM Bank and the Life and Savings cluster already has a seamlessly integrated experience for customers through the rewards program. This gives the benefit of increased customer engagement, richer insights into customer behavior, and the opportunity, mainly in the mass market, for improved premium collections and retention. So VNB is a key metric for the Life and Savings cluster. And it is key for our competitiveness and overall commercial sustainability. The recovery back into the group range will be driven largely by Mass and Foundation and Personal Finance. Mathematically, if every business unit hits the middle of their range, we get back into the group range. And as we deliver better than average performance in each range, we will move closer into the middle of the group range. The key levers to drive our improved VNB, persistency improvement in mass, strengthened propositions across retail, and cost optimization. I'm confident that with the actions that we're putting in place to drive these levers in the right direction, we will get into the VNB range for the group. Net client cash flow and assets under administration and advice, rather than VNB, are the more relevant metrics for our wealth business. So the team has focused over the last decade and even longer in putting in place a growing range of in-demand capabilities, the most recent being, of course, the 10x passive and EFT capabilities. Ease of doing business, as I mentioned earlier, for intermediaries has been a really critical factor. We've had excellent growth to date, driven largely by the face-to-face distribution channels managed out of the personal finance business, as well as a private wealth planner business and private client securities. This is now bolstered in the direct-to-customer base by our 10x acquisition, giving a strong direct-to-customer offering. So Clarence, we also attract some of the younger, more digitally savvy customer and don't become old Life and Savings. Rounding out our business units in the Life and Savings cluster, Old Mutual Corporate, a business unit I have a bias towards, having led the business for just under 6 years. It has a leading franchise in the employee benefits space, from being the #1 commercial umbrella fund provider to at almost 28% market share in the group assurance space for large schemes. Large schemes, by the way, tend to be stickier and tend to be easier to price for good overall margins. These are strong foundations for growth and leverage across the cluster. In a market with little to no organic growth, a more strategic response is required to grow in the corporate space. Over the last few years, the team has been putting in place building blocks to become an ecosystem player in employee benefits to drive both growth and retention. If I pick out just two of the blocks that we've put in place, REM Channel is a specialist remuneration survey and advisory business acquired in 2021. Integrating REM Channel's offering into the employee benefits advisory space has resulted in greater stickiness of large clients and the ability to attract new business opportunities. A more recent partial acquisition, Fairhead's Beneficiary Administration, is the leading administrator of beneficiary benefits in South Africa, and this gives us reach broader than the pre-retirement product set. Overall, there's been faster convergence between retail and institutional retirement solutions, aided in no small part by the recent two-part regulatory changes. Individuals can now interact with their employer-sponsored retirement funds without going through their human resources or human capital departments and without any knowledge of their employer. This was not possible in the past. We are ready for this accelerated convergence by the investments that we've made into member engagement. Our Gen AI chatbot, Tuso, is available via WhatsApp to all of the members in our Superfund customer base. Tuso is available 24/7. She's infinitely patient and highly scalable. So we are ready for the accelerated convergence at scale. Currently, we retain 35% of pre- and post-retirement outflows from our umbrella fund into the overall Old Mutual ecosystem. Through the cluster setup and the digitized member engagement, we have the opportunity to increase the retention of those flows even further. The Life and Savings cluster is a combination of 4 really great significant businesses. We have opportunities to unlock value from a large in-force book and the recovery of our new business margins. We know what we need to do, from fixing the basics to proposition enhancements and extracting cost efficiencies. We have set ourselves up to act decisively and drive execution with accountability and commercial focus. I look forward to reporting back to you on the progress as we deliver. Thank you.
Thank you very much, Prabashni, for that very comprehensive coverage of the nuts and bolts on execution, linking very well and tying up to the presentation from Clarence. So at this point, we have given you, I think, a very good view of how the management team, particularly Yuri, as presented earlier, thinks about the strategy. You have a good sense of the key nuts and bolts in terms of execution. You have seen the targets that we've put up. You've also heard about the fact that the unlocking value and generating growth, while they may appear sequential, that we are already executing and working on some of those with some proof points already presented on that. So I would like then to start shifting directly to the Q&A. And as a reminder, for those who are joining us online, the platform is Eclipse. You go to the Q&A tab there and post your question. The team will direct the questions to me. And for us in the room, there are roaming mics, and you just please raise your hand and ask the question. I will just switch things up and start in the room whilst I get the team ready online. I see your hand is up. I'll take you. Warwick, I'll take you next there. So there are 3 questions. Is there a 4th hand? Okay, so I'll take the two on this table, one, and we get to that. Whilst they're getting the mics to the team, I'll kindly ask Clarence, Prabashni, and Yuri to please come and join on stage. Thank you very much. We'll start with table one, gentlemen.
Morning, thanks for the presentation. Warwick Bam from RMB Morgan Stanley. Our first question is just on tracking the cost savings. You used VNB margin for the life and savings business as the key metric. Obviously, your VNB margin has always been a target for that business, and it includes assumptions about mortality, persistency, mix, product design, etc. So do you think it's the best measure? Why did you get, maybe you can just give us a sense of why you got to VNB margin as the best way to measure expense efficiencies in the business? That's question one. My second question, Clarence, just if we hone in on the lend and extend strategy, specifically the lending book, it hasn't grown for several years now. I mean, how do you think the new bank changes your lending appetite for one and your underwriting process? Like what will improve, what sort of appetite do you have to lend, and will it be across the income brackets? Thanks.
Thank you, Warwick, for that question. Yuri, yeah, let me just take at least three, Yuri, and then we come back. I'll try and cluster them. Yeah.
Okay, it's Marius Strydom from Austin Lawrence Kidden. My question is about corporate. So you have increased your target underwriting range for P&C. Have you similarly increased your target underwriting range for group risk and group disability? Because it's, excellent times at the moment in this industry, as most will know.
Thank you, Marius. Let's take over those two questions. I think, Yuri, if you may just maybe start with the targets one.
Thanks, Warwick. I mean, I think just to go, so the setting of the target, obviously the setting of the 2.5 billion was sort of set at a high level to say, where do we, and which was kind of early on, so we know we need to take costs out of this business. Where do we need to pitch it to get ourselves into where we think we need to be from a VNB margin range, right? So it was high level. When we show VNB margin, I say high level, a lot of work went into it, but I mean, that's kind of where it was pegged. When you go per cluster, it's not that we're only going to be measuring VNB margin within life and savings. I mean, experience variances and, maintenance unit cost, all those things are further KPIs. We don't want to clutter the slide with it. We're just trying to give clarity, but obviously it's a much more detailed exercise actually tracking the expenses.
Thank you. Clarence?
My mic? Yeah, luckily I've got the CRO in the room and is going to take that question around our risk appetite. But while they are giving him the mic, I mentioned that we've got moderate risk appetite for lending in the bank. And we are very clear that we are not going to open ourselves to the high risk category of customers. And here we're speaking specifically in terms of income segment. We are not going to play in the sort of 1,000 to 8,000 type customer. And we're also, not open to certain risk grades that are quite high risk versus, what Old Mutual Finance was providing. But let me give it to the technical guy who will talk more about those things. Yeah.
Yes, thanks, Clarence. And to add on that is that we will be using a lot more data and client insights in order to understand the client better and as a result be able to offer clients that ordinarily would not qualify, but if we understand their patterns better, using our data, we'd be able to offer credit to those clients again. Also, using client data that is for the lower client range and the unbanked, where we are using data including their shopping habits, including their profiles and how they behave. By using the data that sits in the bank account, we're able to profile their credit profile a lot better and extend credit to those clients. So that's how we see our book growing. However, we will be doing that again within a very conservative risk appetite, and still being able to grow the book in that line. I hope that.
Maybe just to add, Lushandra, maybe you can talk to how we see as we gather deposits and how we see that changing over time in terms of utilizing the deposits for lending purposes. Because I think there's an assumption that immediately you open your doors, as we gather these deposits, we might be able to utilize them immediately.
Yeah. Yes. So as you may know, that as we start as a bank, our deposit profile will be call and overnight deposits that we'd start with, but over time we'd build more into fixed and term deposits. Our call deposits that we raise from day one aren't able to be used to deploy into lending, because we haven't established initially a behavioral profile behind those deposits to determine how we match our liquidity over this period. So what we would be doing is we will be building our deposit base, and over this time trying to get a behavioral profile behind that to understand the stickiness of the deposits and what portion of those deposits we can use to lend. So initially we'll be looking to wholesale funding to support our lending ambitions while we build up our deposit profile and our deposit tenor. So it's very important to get a well-termed out deposit book as we build out over time. So that's a key focus on our side, is that while we are focusing on our lending business, we are closely focusing on how we build our deposit book.
Thank you.
Milanga, just to add, I think that's one important point, that the point around leveraging the group's assets, not just actually on the distribution. It's actually, there is a massive advantage in not starting from zero on the lending side, because you're working off an existing book. And so we have a book that's funded by long-term funding actually through the group, and you've also got the through our liability generating machine, and you've also got the opportunity to leverage the group assets on data. So that's like the next step, which I think that Lushandra just alluded to, is like the use of our rewards data and our persistency data to ultimately actually, what you want to build ultimately is a competitive advantage in lending. As ambitious as that sounds, I think you want to use your data to be able to do that.
Thank you very much.
Our range just over a year ago was sitting at 0.7 to 1% for our overall VNB margin. We've increased it to 0.8 to 1. Trying to remember if it's 1.3 or 1.2. Might be 1.2. 1.2, Humphrey is confirming. And then it just depends on the mix of business. So, it just so happens in H1 of this year, we've written a high volume or high mix of group assurance business, which has actually pushed our margin above that range for H1. But Humphrey just needs to land a massive additional employer into the super fund, and that's going to swamp the size of the group assurance and then bring the average margin down again. Yeah. And group assurance, as you know, is cyclical. We're still coming off the top of a wave. How quickly it goes down, we'll see.
Thanks, Prabashni. I'll move over to Mike on the table 2, please. Could we please get the mic on the... Thank you.
Thanks, Mike Christelis, UBS. 2 questions, if I can. Firstly, sort of congrats on your targets. I like the transparency that they bring, but just your ROGEV in particular, right? You've never historically generated a double-digit ROGEV since listing separately. And even if I exclude kind of COVID 2020, 2021, I mean, you've struggled to do much better than mid-single digit on a ROGEV basis. What gives you the confidence that you can get to 14 quite reasonably easily over the next 3 years? And I think possibly tied to that, and maybe this will answer some of the question, the 2.5 billion cost savings target, to what extent does that deliver positive expense variances versus VNB on the new business side?
Thank you, Mike. I'll come back straight to them.
So I think I mean, Michael used I'm going to ask Ronan to comment in a second. Where's Ronan? But I mean, it is an ambitious target relative to where we've been historically. I think we've been through a process of kind of resetting GEV, and you will have noticed some of the things like the persistency variance that we took in the middle of the year, the cost of non-hedgeable risk which also took in the middle of the year. So I think what we're also doing is gearing our GEV to be a GEV that you can get that you can earn a return on. Getting into V&B range is a key lever of it. It's kind of at the margin. It's a big difference to kind of getting into that range. So I mean, I think that it is an ambitious target, but I think that when you move into ROGEV, you have to achieve a ROGEV that's above your cost of equity. And the cost savings, as you rightly point out, is a significant piece of that.
Michael, yeah, thanks. So in terms of building up to the 14% ROGEV, I mean, that is a critical piece of work that we're trying to uncover through our business plan. And we are breaking down the unwind of that ROGEV into its components. So the risk-free rate unwind, our variances, and our expected returns. And we're driving that through the business plan to get each of those categories into the right space. As Yuri mentioned, one part of that was getting the base right, so getting the bases right so that we can generate zero positive variances, not sitting with negative variances. We also need to do some work on our expected returns, which is what we're dealing with in the business planning process. And then expenses is the biggest lever. So that is going to be the most critical thing for us to get right. And in our planning process, we're working through the next 3 years. When do those expenses get delivered? How do they drop into covered and uncovered? And so that we can get to that delivery. But that's still very much a piece of work that's in progress. But that's the goal. If we get that right, we'll get the VNB into range and the ROGEV to the 14 to 16%. Thanks.
Thank you very much. I think the table over there. Thanks, Wendy.
Hi there, I'm Brad Mock from Peregrine Capital. Clarence, just a question on the bank. You spoke about multi-banked feature in SA. The new client numbers look really impressive. What proportion of those clients have you seen actually deposit funds into their account? How's that tracking relative to expectations in terms of inflows deposits? And then Yuri, Clarence, you spoke about cascading targets down to the business units. In terms of the bank, what are the key metrics that the bank exec team has been incentivized to hit over the next few years?
So what we have seen, particularly in the month of October, because that's when we had this massive surge in terms of customers, more than 60% of the customers are funding their accounts, and they are doing that within a 1 to 3 day period. And then we have another circa 10%, 15% that do that over time. And we've also seen a phenomenon where a lot of these customers, what they do when they sign up, they redeem the rewards points and put it into their account to fund their accounts. And the third thing that we, as a result of just watching these things, is we have also decided, and we're implementing it very soon, minimum balance, like a 30 Rand per account, just to make sure that those accounts, they don't go into dormancy very quickly. So if you have that 30 rands, you are able to prolong the life of that customer, and then you start engaging with them, and out of that engagement, then they will start transacting, and you monetize them over time.
Yeah.
So I think just on the target piece, I mean, I think we are now very much transitioned from build to run, right? So we've gone from milestone-based incentives around being able to go live and in fact, there's been quite a significant shift within the organization in terms of how we run things. The targets are going to be, we're working towards break even, obviously, from a top-down perspective. That's the key thing we want to get towards. And so there's a cost management piece, making sure that you're actually a low-cost provider in the mass market. And then there's the revenue piece. And the revenue piece is anchored around the model, which is the customer model, number of active customers, more active and less active, and then there are revenue metrics associated with that in the model. And so we are in the process of finalizing those scorecards for the next year, but it'll encompass those components.
Thanks, Yuri. I would like to just switch back to the questions from online. I'll come back shortly to the room. Staying with the bank, we've got a couple of questions, Clarence. Yash from Alan Gray, he would like to know, may you please give us some clarity around the tech stack of OM Bank and why the cost structure is so scalable? What proportion of the cost base is fixed versus variable?
Yeah, so I've got the techie here with me, Ray, who's our CIO. He will be able to take that question. But like I said in my presentation, year one, 38% of our costs will be variable. And by break-even, which is year three, the pendulum will have swung completely to 58% variable and the 42% being fixed, and it's fixed per customer.
Yeah. Over to you.
If I could just add to that, I think one of the privileges of building this bank was the ability to build a modern tech stack. So it's completely cloud-based. We were quite relentless in the process of building to make sure that we pushed really hard on the unit costs and the variable costs around that. And that puts us in a position where, as we go forward, we can scale and we see incremental cost growth as we're bringing on more customers there, instead of having a linear correlation between number of customers and the growth that we have. So it's important to be secure and stable as a bank, but I think that we also have really lived up to the design principles of having something that is very quick to change and looking to the future there.
Yeah. Thank you for that answer there. Just moving on quickly, still staying with the bank, Tapelo from Investec. He would like to know, on the bank, please talk to the monetization differences between young customers relative to the old customers, and how does that look for your break-even target numbers for customers?
Yeah, but I will just talk to the monetization of young people and older people. So young people, they want to watch YouTube, Netflix, Amazon, Apple, whatever. So those are the type of things that we will be engaging them on and making that available from a value-added services perspective. Their parents, they look at different things, and we will focus on the things that are relevant for that particular cohort of customers. Monetization so we haven't broken down our revenue in terms of saying, this is how much we'll get from monetization, this is how much we'll get from engaging with the customers. What we have taken is just sort of a basket of transactions that are typically conducted by a mass market or a middle income customer, and said, well, that times the fees that we have should give us a net transactional revenue of X. And on that basis of that, plus the net interest income that we will generate through our lending activities, minus the cost, should give us a break-even point. So that's how we're looking at it, without breaking into monetization is X, engagement is X, whatever. To just take a basket of the whole thing and then multiply it by the fees that we will generate out of that and the commission that we will earn from providing those value-added services.
Yes. Yeah. Staying on with the bank, also Harry would like to know how much are we expecting to spend on the physical distribution, that is the branches, and also on the ATMs. He also asked, what service can customers expect out of the branch infrastructure?
Yeah, so from an ATM perspective, we're still investigating the model that we need to pursue in terms of this. So definitely we will get into that, because the market has demonstrated to us that they are interested in withdrawing cash, and we have seen through the activities that they've conducted that they want to withdraw cash. So we have to. And we have also received a lot of feedback which says without an ATM, people really don't believe that we are a bank in the mass market space. So we will invest in ATM. As to how much it will cost and everything, we're not yet clear. We need to get the costing around that, having an understanding based on the model that we are going to pursue. In terms of what happens inside the branch, a branch is a marketplace for everything Old Mutual that is provided to a customer who prefers a face-to-face or to be digital assisted inside the branch. It includes insurance, it includes even Two Mountains is going there based on what I've heard. The banking piece of it is also the lending piece, Old Mutual Connect, which is the mobile virtual network operator. So there's a whole host of things that are happening within the branch. But what we have been very clear is that a branch needs to become a true marketplace. And true marketplace means there must be more sales inside the branch than service. So anything that is not value adding, we are trying to put it on the digital apps and all those things so that customers can engage with it. As to how much it costs to acquire a banking customer via a branch, I need to come back to you in terms of that.
Okay.
Maybe just like to say that the branch costs are obviously already baked into the Old Mutual Finance costs and P&L. So that branch, the full branch costs are sitting within Old Mutual Finance already, and it's already part of the banking cluster.
Yeah. Thank you. So just to wrap up with one question from Baron, JP Morgan. This is for the bank and the life and savings cluster. Baron would like to know a few things. One, how will the bank help us accelerate the insurance products, the growth of that insurance products to the customers? That's a part, particularly in MFC and personal finance. And how will the success of this integrated execution be measured? I think, Yuri, you may also weigh in on that. Yeah. But
so we were discussing during the break the commercials for the insurance products that will be available via the bank. So of course the branches are currently run by Old Mutual Finance, and we have advisors who sit in the branch, full service advisors, both for the mass market and the middle market, and those will continue. We also have on the Money Account app available simple funeral insurance cover. We are working with our banking colleagues to provide relevant insurance products on the banking app. So the banking app will be a place where customers can have relevant solutions as they navigate their financials. We will be Clarence's insurance provider of choice. From how the benefits of that emerge, on the life and savings side, customers who acquire their insurance solutions from their active banking partner have better persistency and better overall stickiness. So we expect that to come through. The cost structure associated with solutions obtained via the banking app and other bank channels will be different to the tied advisor model. And of course, we will be sharing the economics.
Yeah, so yesterday I had a nice long debate, and we came to an understanding with a good friend of mine who's the CFO of MFC, Johan Lotz. And I also had a similar conversation with Matthew, who's the incoming CFO of the LNS at a point in time. So we have been given a gift here through the leadership of Yuri that we need to run these businesses as businesses, and we need to negotiate at an arm's length. So here's the thing. The customer that, who's a bank customer, they experience the bank as giving them 20, 30% better value versus market average. So when they engage with the bank and they see that the bank provides insurance solutions, what is their expectation? They're expecting that it will be a similar value that is given back to them, 20 to 30%. So we cannot have a situation where we are nice to each other at the expense of the customer. I need to make sure that the customer that belongs to the bank gets what they are expecting when they engage with the bank. So therefore, we need to really negotiate very hard in terms of this. And there was an understanding between myself and Johan, by the way, that there's zero cost of distribution. So therefore, we will be in a position to give that value back. But we needed to have that conversation, because if you don't have that conversation, you end up running businesses as if they are sweetheart shops, and you end up losing value or destroying value in that process. Yeah.
Maybe I'll say that, arm's length commercials gives me a warm, fuzzy feeling. Robust commercials. I think ultimately, what I will say is that building a functioning, integrated branch network is not easy to do, right? It actually, because you can't build it off the back of simply servicing. The economics doesn't stack up. You've got to actually build it off the back of a bank model, and in particular with lending. So the fact that we already have that integrated model, it means that flywheel is already actually moving, which I think is hugely encouraging. And I think we're going to use these. We're going to use the model to be able to really deliver, which is what Clarence is saying, really deliver competitive propositions to customers. So when you walk in as a customer, what's important is not our internal arm wrestling. It's actually, what are we delivering to customers in terms of value? And I think they do look. We've seen with banks moving into insurance, they look across the value chain, and I think we will do that.
Yeah. Thank you. Let me come back to the room. I know there was a question coming up here. There's a question over here. So you have the mic already, so please do. There will be a second one. Is there another hand still in the room? Okay, there's a third hand here, and a fourth one. There's another one here. Okay, we'll come back last. Please, over to you.
Morning, Kobus from Value Capital Partners. Just want to come back to the tech stack quickly. So it's actually a question for Clarence and for Prabhashini. So obviously the banking system, new, off the shelf, everything's working fantastic. Just want to understand exactly how the integration with the legacy systems are currently, because obviously there's been a massive upgrade that you guys have gone through with the Greenlight system and everything in there. But how are those systems talking to one another, and is there any specific work still ongoing on that front?
Thank you. Ask Karen. I think Karen is here.
She was here.
No.
At the back. There, she's at the back, yeah.
Hi. So Karen's very, very close to the life and savings retail. Is that the?
So just to be clear, there are a few
on
10Xs.
the bank or the, yeah.
So there's 10X, which is the platform that is an underlying platform provider within the bank, and then there's 10X, which is which is an international business, and there's 10X, which is the local business which we've acquired, which is an ETF and passive provider.
I thought you also mentioned Greenlights, which is why I hold on, Karen. Yeah.
Yes.
Yes.
I think it's a bank question, actually.
It is.
Is that right?
Yeah.
I think actually a bank question.
No legacy from my side. I don't want to touch what she has.
He just wants our customers, profits.
That's it. I don't.
He left legacy behind.
I'm serious about it. So, I mean, maybe Ray can just take the question, yeah.
I think importantly, our stack in the bank has been built from scratch. But I mean that doesn't take away from the fact that we integrate within the group. That's from rewards to where we have the ability to use customer data responsibly in terms of what we're allowed to do. Those rails have already been built and have been integrated. So today, if you were on the banking app and you wanted to close your money account, as an example, that's a journey that's facilitated inside the banking app. Touches a number of legacy systems inside of the group, and from a customer point of view, that will operate seamlessly.
Thank you, Ray.
Senamile from SBG Securities. On the VNB margins, are you able just to provide some color on how you expect the product mix to shift in order to achieve the targets? And then secondly, I know we haven't touched on rest of Africa, but how do you expect rest of Africa to contribute to the growth targets?
So since Karen has a mic, I think. Oh, you don't have a mic anymore. Oh, it's right next to you. Karen can talk to product mix in the middle market space, which is where mix will drive some of our margin recovery. And then Yuri will do Africa regions.
No, is that?
So what we saw and what we are trying to change is during the COVID period in particular, our mix swung a lot more in the middle market towards products which didn't require underwriting. So advisors were looking for the easy sale where people didn't have to go for blood tests, they didn't have to go visit a doctor or a hospital. Everyone was kind of steering clear of that. And what we've been working on is swinging the mix back more to our margin-rich products because funeral for us is quite low margin. It's different in the mass space where the sales process is much quicker. Our advisors spend quite significant chunks of time with customers, so we've actually got to have a richer product margin to accommodate that advice process. So we have been gradually swinging back more towards fully underwritten as well as things like critical illness, sickness, the living benefit products. In that space, they're less commoditized. You're able to differentiate on your conditions that you cover, etc. So definitely pushing more back towards that. And then our savings space, very much making sure that the mix is more about the level of value chain integration. So how much internal sort of fund margin can one put into your mix? Making sure we've got appropriate solutions across the spectrum. So from our multi-managed space to private client solutions, through to single manager solutions, and actually now with 10X, the passive space. And then lastly, the last area is really our mix in terms of guaranteed annuities versus living annuities. The guaranteed annuity space is richer margin. There is an industry pattern there where obviously interest rates play a big role. but we increasingly sell blended products to our customer set so that we get a little bit of both kinds of margin.
Thank you, Karen. I think we'll stay on the table there.
Just that there's an Omar question.
Okay. Oh. I'll come back to you, Asanda, just now. Please hold.
The answer is Omar is going to make substantial contribution to VNB.
Yeah.
Clement, can you-
Yes. Do I need to? Oh. So the contribution to from Africa to that target of 2 to 3% is, we are also going to get into the 2 to 3%. You'd have seen that at half year, our VNB margin was low at about 0.2%. We are going to bring it back up. A lot of that the reduction came through in Namibia, and there's some work that you're going to do in there, including cost savings, to deliver that. Yeah.
Thank you, Clement.
Hi, morning, or afternoon, whenever. Asanda Noche from Mazi Asset Management. So Yuri, you're allowed not to answer this one. In fact, don't answer it. So over the last 10 years, integrated financial services, rewards program, all of this stuff was there. So I'm not trying to be like that whole party pooper here. What did not allow for execution over the last 10 years to kind of where we are now, given that the plans were, let's say, 70, 80% there? And perhaps what's changed? Thanks.
I'm not allowed to answer that question.
Yeah.
Okay.
Thank you.
It's actually, that's a great question for people to answer. In fact, we can open it up to the ExCo team, actually.
Yes.
Yeah.
Yes.
So I think I hinted at it a little bit. For life and savings, certainly we had increasingly centralized a large portion of the capabilities in the value chain, which brought us huge advantages. We made some investments that unlikely to have made if we were highly federated as businesses and silos. We launched the rewards program. We took our tech stack into the cloud. We did lots of things. But I mentioned that, as the business grows, as it evolves, aligning multiple parties starts becoming increasingly difficult and slows you down, actually. And making trade-offs in parts of the value chain versus making the trade-offs across the entire value chain. So that's my hypothesis, partly.
Or maybe just to add, by the way, he asked me this question during the break. He said, Clarence, I've heard you speak about these things 10 years ago and you are repeating it. So I think the big difference is we used to have ownership without authority. Now you have got ownership with authority. And when you have authority, then you need to exercise that authority in terms of, getting things done and then being held accountable, because you can't blame it on Prabashini. You have got ownership of the entire thing and you have been given the authority to orchestrate everything to deliver it. So there's no hiding behind, it's Prabashini who was supposed to make that decision, it's Clement who was supposed, you have got that full authority. That's how I sum it up, yeah.
Yeah, thank you. Feliwe?
Hi, good afternoon. Asanda, it is afternoon. I just thought I'd give a different response. My name is Deliwe Ross, and I look after human capital and corporate affairs for Old Mutual. Operating models are not the silver bullet, and I think it's important that we don't pin everything just in terms of change of structure and strategy. All these things are related. And the reality of large and complex and, I hate to say it, Clarence, old organizations is by their very nature, they are made up of people with habits and ways of doing things. Fundamentally, I think clarity matters. In the absence of certainty, clarity certainly is important, but it's also accountability about what gets done where. When Yuri opened in his slides, at some point he talked about the fact that we've never run this business this way before. So it's both operating model, it's clarity and incentivization, being very clear about what the cost of winning is, but also not. And then lining up the org and the forces to be able to get to that prize as quickly as possible.
Thank you. I'm going to switch back. I'm sure I'm not missing any question, Wendy. Okay, there were two more, yeah. Thank you. It's Marias.
Matthew Pouncett from Laurent Capital. Yuri, you can answer this question. You've given in your targets a dividend growth as opposed to an earnings growth number. What's the thinking behind that? Does it imply better cash conversion of earnings? Maybe just a sense of why that was given as opposed to earnings.
I actually think, Cass, do you want to, Ronan, do you want to? That's Ronan, carry.
Hi. Yep. So we have given a 6 to 9% dividend target because we're trying to give more clarity on the eventual distributions to shareholders. When we give an earnings target, it's a little bit more difficult because we can do that on our operating earnings, but we have a sizable shareholder portfolio that creates volatility. What we're trying to communicate to you is we have a strong balance sheet. We can manage through the cycle and give you more confidence on the cash distributions that we can deliver to the shareholders. So it's to enable shareholders to better value the business. That's the point of giving the target on dividends. Thanks.
Thank you, Ronan. Marius, over to you.
Oh, thank you. Clarence, my question is for you, but I guess also for the wider team. Now that we've got more strategy about the bank going forward, we're moving towards a break even. The 5 billion odd that was spent to date, can you give us some kind of breakdown on what that was spent on?
The last part?
What was the startup costs of 5 billion odd for the bank roughly spent on?
Let me give it to Ronan because I think he does a good job of breaking it down in terms of 1.7 billion was for the tech stack and everything because we have disclosed that part. Yeah. And there's also part which is regulatory capital. So maybe I can just hand it over to him. Yeah.
Repeat the question for him.
Oh, you were not. He's saying we have spent 5 billion on building the bank. What did we spend it on specifically? Yeah.
Yeah, so look, I think that is a mix of the salaries to do the build work and the underlying tech stack, Marius. I mean, that is what the build is. We actually have very little that's built up as an intangible on the balance sheet. So that has been to get us to where we stand today. Some of that has gone into the capital to support the business, but that expense base is starting to transition now to a BAU running cost, and that's where Clarence has given the guidance that it's the 1.1 to 1.3 billion that will then run down to the break even. But it has been the investment into the tech and the salaries that went along with it.
The observation I'll make, Morris, is that when you're building a bank, it's a hard thing to do. It takes time. You've got to get through the milestones. You've got to get through the Reserve Bank milestones. You've got to have the capability to demonstrate that you can get through those milestones with the Reserve Bank. So it actually adds up pretty quickly when you start to have a run rate of people and technology that can get you through the milestones of your licensing that you can actually go live. I think we would have, I came in a little bit halfway or maybe towards the end of the journey. I think we would all have said we would have liked to you always want to try and do it quicker and cheaper. But I think we are where we are, and I think the complexity of getting there is not to be underestimated. That's why this is a business that's kind of hard to get into. And then once you've built what you've built, you've got to leverage it.
Yeah, I think I will switch back online and switch just the theme. We're going back to targets. The first question comes from Jared Allweather. He would like to know: is it fair to expect results from operations growth in the medium term to grow at a similar rate to the newly announced 6 to 9%? I think similar question that just came up. Dividend per share. That's the first question. I think let me hold it there and deal with that. And I'll move to the next one. I'm looking at Ronan and Caspar. You're happy to? Caspar, please.
All right.
Yeah.
To the point that Ronan made earlier, but just adding a few points. So under IFRS 17, our profit emergence has changed quite significantly from what we would have seen in the past. So it's dependent on what you've done over a very long period of time and how that then gets released from your CSM. That's then impacted by the rate of growth of your new business and how much you've spent on that. So, and then Ronan's point around the volatility of markets in terms of the fees that we generate. So it becomes, and remember, not all our business is is IFRS 17 business. So for us to give you a forecast on earnings, which is what you're asking for, is a lot more difficult. If we felt comfortable to give you, a forecast on earnings, given the volatility of markets, we would have done so. So I think it's important that we look at all those factors. We think the 6 to 9 dividend growth, where we can actually, see the cash earnings, we can adapt with the volatility that we get in our earnings profile. Is a much better signal for what you can look at as the underlying growth in the business. Thanks.
Yeah, thank you, Caspar. I'm staying on the theme of targets. Gershwin from the Eskom Pension Fund, he would like to know, Prabashni, I think also at the group level we can please do come in on the answers. He'd like to know on the segmental and group VNB margin targets. His question is, the MFC's new VNB margin target of 5 to 7 used to be 6 to 9%. So given that the overall group target has not changed on VNB, which segment's target may have changed, or is this will the outcome on the target be just a combination of some of the segment's targets?
So yes, the MFC target range has changed, recognizing a couple of things: the increased competition, over time, credit life, which is currently recognized in MFC, when Old Mutual Finance was part of the cluster, will start to emerge in the bank. So we're recognizing that and the competitive change in the market. We need to recover our margins in personal finance. We are sitting at I think a low point now, and many of the actions we've listed, including Karen's comments on mix, and where we have to take out cost and where we have to drive volumes. So the overall delivery of the cluster depends on all of the business units. So recovery in the mass business and recovery in personal finance are the most critical, simply given their size relative to the new business volumes from other BUs. Yeah.
Thank you. Jared from All Weather, I think I'll hand it over this one to you. It's about just the clarity on the previous cost guidance versus with the one we've just announced today. Jared asked, does the cost savings target include the removal of duplicate system cost, and what other central cost will be removed?
Yeah, so I think what we're trying to do is just simplify the cost guidance there were a couple of cost guidances that were before. I think it was central costs in line with inflation. And there was also the piece around double run costs. I think this is an all-in number for the group. And the reason it's got to be all-in is because we're not just talking about the central segment now. We've actually pushed a whole lot of costs that were sitting at the center. We've actually pushed into the clusters. So what we're trying to show you is the number which at a group level, cost targets happen because you push them, right? And you make a decision, you drive them through the business. They don't necessarily bubble up organically from the bottom. You've got to push them into the business. So you start with what do we need to achieve as a group, and then you push it into the clusters, and the central segment. And the work we're doing is and this is through the business planning process. We are benchmarking each area according to where they need to be in 26, 27, and it's different per business. And then we've got to see the actions that then deliver that.
Yeah.
There has already been some progress in this year at the central segment.
Yeah. Thanks, Yuri. I will take 2 more questions online and I'll come back to the room. James from RMB Morgan Stanley is asking, Prabashni, this is specifically for you, that you've mentioned the debit check and its impact on collections. 1, could you expand on the nature of the challenge that the debit check is causing? Is it authentication, cost of the debit check collection? That's the first part of the question. 2, please can you give us some color on what to expect from the bank strategy? Okay, the second one is yours, Clarence. From the bank strategy that can be leveraged to improve collections. I think it's about how the 2 business units, we can comment on it, Prabashni. We will leverage that.
I'm going to invite Matthew Brinkman, our incoming CFO for Life and Savings, who's also head of operations for MFC right now. So a versatile individual to comment on the debit check point.
thanks. Yeah, so I think DebiCheck is, I mean, looking at it now, DebiCheck is actually the opportunity for us to improve collection success rates. But what happened with the change is under the old system, NADO, we automatically obtained mandates to collect premiums in an early collection window. When DebiCheck came in, we needed to go and obtain those mandates from our customers at the point of sale. And in the earlier years of that change, you know, we weren't obtaining a high enough proportion of DebiCheck mandates at the point of sale. Now we are, and so if we obtain a DebiCheck mandate, we can collect in the early collection window, which means the collection success rate is higher. So that's really been our big drive. So I think the challenge of the past was, you know, we didn't have the level of mandates we were looking for as we switched from the old system to the new system, and I mean that applied across the industry. And so we've had a huge push to make sure at point of sale we obtain a DebiCheck mandate from our customer. And as I said, that means we collect in the early collection window, greater collection success rates.
Matthew, maybe before you sit down, could you just add some color for the room on the breakdown, high level, top of your head, stop order, debit order, shape of the book? Yeah.
Sure. Yeah, so I mean, we've obviously got a very, the MUC business, you know, has been a successful business for a long time. We have a large proportion of stop order business in the book. In the in-force book, it's about 50-50, stop order, debit order. But obviously, as patterns have changed, customer preferences, pay office behavior, etc., that has shifted. So it's actually a much greater proportion of debit order for new business. And then on that debit order business, obviously, our aim is to make sure we get a higher proportion of DebiCheck mandates as is possible.
Yeah. Thank you. There's a question from Anonymous, last one from online.
Can Clarence finish the second part?
Yes, so what I wanted to say in terms of, so we need to comply with the rules in terms of payment rails, right? So we can't give preference to Omlaxa or any other sister company in terms of, you know, making them priority in terms of collections and the like. So there are rules that needs to be followed in terms of that. So we'll stick to those. But some of the things that we can help in terms of managing persistence and the like is, for example, in the Mason Foundation cluster business, each and every week, after they've issued or before they issue a policy, they will ask the banks as to whether this is a valid account or not. So that's the only thing that they're doing. So, but what we can help them is whether it is a valid account and there's money inside that account and there's movement of money and how is the customer behaving with that money. I think that will be very useful because it will help in terms of reducing the number of not taken up policies. So a lot of people give you a bank account, you verify it, it gets a tick, but there's no money inside it and you don't know about that. So we will have that advantage of informing them to say, guys, we don't think this account you will be successful in terms of collecting. And then the third one is just to give them insights in terms of customer behavior, how they are behaving with their money, to warn them if there's a likelihood of you know, persistency challenge. We will be able to inform them in terms of that. Yeah.
Thank you very much, Clarence. Prabashni, I think the question one from Anonymous here, but it's referencing back to your slide about corporate and the fact that corporate is a leader in a smooth bonus. The question is, do you see that concentration as a further growth opportunity? Do you have some runway there, or is it a threat, the fact that we have that concentration?
Thanks. I'm going to invite Humphrey Mkwebu, who is the Managing Director of Old Mutual Corporate. He's thinking intently to take that question.
Thank you.
Thank you. I think scale in our space is always an advantage. We can price better. It's an institutional business. It's institutionally priced. So concentration and consolidation are always a positive to us. The regulator is pushing for that, and so are we. We're riding that wave. So to us, it's not a negative, it is a positive. We need to manage it very pragmatically, though, to ensure that that scale, that concentration is also still inclusive in terms of other players in the space, intermediaries, the smaller asset managers, and the other role players. Yeah.
We've seen some of our larger peers enter the smooth bonus space in recent years, peers who were vehemently opposed to the strategy in the past. So I think that puts us in a good position.
Yeah. Thanks, Prabashini, and thank you very much, Humphrey, for that. I'll come back to the room. Yes, this table will be the first, second. May I get a third hand? Okay, we'll take those two. We'll start right at
Thanks for having us today. My name is Jan Meintjes from Denker Capital. Clarence, maybe you can start it off, as one of the reasons for the bank. You spoke about the experience of managing credit and running a loan book in Old Mutual. You haven't really talked about a lending strategy within the bank, and maybe you can just elaborate on, you've got an existing large business with a large book. Do these two businesses sort of coexist side by side? Does the one facilitate payments for the other? Do you plan on building a separate credit book within the bank? And maybe you can talk around some products that you think is important in that environment.
Yeah, so I'll invite Lushandran also to comment on this. But ultimately, we are going, subject to regulatory approval, integrate the businesses. That is the end state of where we're going. The modalities of how we are going to do that is something that we are still working on, but it is subject to regulatory approval. Lushandran?
Yeah, if I can add on to that, to say that after we do get regulatory approval and we do amalgamate the businesses, we are looking to use the expertise that has been built up in OMF and to grow the book within the bank using, as I mentioned earlier, the benefits of data, because now clients will be banking with us. In the past, when OMF was just lending to clients, we didn't have the benefit of seeing what the clients were doing in their daily transactional lives. So now we have those benefits to see what they're doing in their transactional lives, to see what they're doing in their rewards lives, and to see how they behave. And using these additional data points that we will build up over the client's journey, we hope to enhance the offering to clients and be able to offer to a wider selection of clients. So I think we're going to actually piggyback off the skills that have been built up and how much we've learned over these last many years in building up a book of 15.5 billion, the collections capability, the impairments capability, the understanding of the book and understanding of the behavior, and then complementing that with the enhancements that we're getting from our tech stack and our data stacks that we are going to build up in the bank. Hope that helps.
Thanks, Lushandran.
Hi, Siam Bata from OMEG. Since listing, the business has gone through various cost optimization initiatives or programs. I wanted more clarity, so I thank you for providing clarity on some of the central costs moving into the various divisions. If we could maybe talk about shareholder costs that sit at the center. What are the targets for the shareholder costs? And how do we ensure that these don't bubble up again as they have historically? And who is accountable for this?
Thanks. I think the first piece, Yuri, if we may just come back.
So I think we're not giving specific guidance right now on the pieces. What we're saying is there's overall guidance on how we're going to take out cost, and we will benchmark each of those pieces. So the shareholder cost piece of what you'll appreciate, we've moved a whole lot of central cost actually out into the clusters. So this is, some of the work is being done as we plan for next year to make sure we understand where the gaps remain relative to benchmarks on those costs. So that's work in progress. I think the issue of wider costs bubble up, right? And I do think that it happens in organizations that big cost targets get set, and then there's a big program, and then the CEO comes back in a year and he says, look, we've ring the bell, we've achieved it. And then when you look again, then the costs have popped up again. I think it comes back to accountability, benchmarking actually in the businesses and being really clear what the right level of cost is for the different pieces of the business. So what we've not done is gotten a management consultant to devise a program for us to show us what our organograms need to be and gone through this like one-off transformation. This is a process where we're actually pushing accountability for these targets into the businesses. We're incentivizing people and holding them accountable. And so, the proof of it will be, for investors, the proof will be in the delivery. That's absolutely right. But I do think we're going about it differently to how we've done it before.
Looks like you have a follow-up.
Sorry, my second question on that was, who is accountable for the central costs, the shareholder costs?
Moi, I'm accountable for. No, I mean, look, central costs to sit in the center. Obviously, the central team, which is myself and Casper and Richard and Zoraida, those are and Liwe, we look at a granular level at what's left in the center, and we're accountable there. But we also will go, it's more than just actually cost numbers. So, for example, when it comes to benchmarking what sits in the center in Zoraida's operations, it's actually on KPIs around like what is the right benchmark for how you manage data, for technology, for rewards, and these different pieces. So if you're running a digital channel, for example, what are the number of transactions that run on that digital channel, and how do you actually then benchmark what your cost is per transaction? It's going to go down to that kind of granular level. And that is definitely not how we've done it before. So, yeah, there will be a discipline around that. Yeah.
Okay. Are there further hands in the room? Okay, we have no hands in the room. I don't have any questions at the moment from the webcast either. So we are 5 minutes ahead of time. I think I'd like to just take this moment to thank Yuri, Clarence, and Prabashni, and the team that joined in answering the questions. Thanks, Caspar.